Turkey's current account deficit narrowed in March from February, the central bank said Tuesday. But has the economic situation in Turkey improved now that the EM sell-off has dissipated, or are there still concerns bubbling under the surface? Wolf-Fabian Hungerland joins me down the line to discuss. Fabian, the recent IMF World Economic Outlook report estimated that the Turkish economy would grow 2.3% in 2014. That's down from 3.5% in October's forecast. However, some analysts have retorted to this outlook by saying the IMF consider every possible risk. Do you think it's correct to paint such a negative economic picture for Turkey at present?
We are also less bullish about the Turkish economy than the consensus. We expect only around 2% growth this year, given our rate expectations and below potential export performance, not to mention that there's still a huge currency risk existent. But the macroeconomic situation is still far from stable, and various factors lead us to this conclusion, which all for themselves pose substantial risk to economic growth in Turkey. Notably, generally, growth will slow down. Higher interest rates take their toll only delayed, so this will not feature in the first quarter, but probably in the next quarter's GDP numbers. Turkey's high external dependence. Turkey's corporate sector has still a huge exposure, roughly 60% of debt denominated in foreign currencies. Also, there's the risk stemming from domestic politics. The big question really is, what kind of government will Turkey eventually get? And lastly, there are geopolitical risks. To what extent can the Ukrainian crisis affect Turkey? And from here, large confidence shocks can emerge, which then influence not only Eurozone demand for Turkish products, but also Turkish business confidence directly.
Delivering his quarterly inflation report in Istanbul, Governor Erdem Baski said declining risks and an improving inflation outlook meant there was room for a limited policy easing. However, others say this would be a mistake until clear signs emerge that inflation has peaked and indeed is moderating, and that the current account is rebalancing. But what do you think?
I think inflation is still a threat. For 2014, we expect around 8.5% on average, and we don't see that inflation is really lowering. The development actually lacks the lira's depreciation of last year, so currently it is even approaching double digits again on a monthly basis, and also, which is even more worrying, is that core inflation is also rising dangerously. Although the exchange rate pass-through will slowly but surely exercise less pressure on domestic prices, we are therefore still not convinced that inflation has peaked. And regarding the CBRT, the current emphasis of the CBRT of decreasing loan growth and the lowering current account deficit is too optimistic in our view.
The unexpected rate cut conversation has also raised fresh concerns that the lender had capitulated to government pressure ahead of the August election. If not now, when would be a realistic time to talk about rate cuts to your mind?
I think it is unrealistic to really consider rate cuts now. Although the doubling of rates in January was necessary and reinforced the credibility of the CBRT, in the current environment there's little tolerance for any monetary policy mistake. Given the continuing political tensions, real interest rates ought to be positive. And given the high inflation, lowering the main rates would destabilize the real lira and probably lift inflation further via exchange rate pass-through. Hence, despite continuing political pressure, we believe that rates should not be lowered until the elections are over and all political questions are solved. I'm talking here about the corruption scandal and the issues between the government and the Gülen movement. So in short, no rate cuts at least before September. Until then, the CBRT might resort to macroprudential easing by using its reserve toolkit. This is, however, in our view, of limited effect and might even leave more questions than answers for investors.
The central bank stated the lira-dollar rate must be in the 2.15 to 2.25 range. But given Ukraine crisis, proximity to Syria, and also the continuance of Fed tapering ahead of their own rate hike expectations, would any intervention be futile? What is your outlook for the lira moving forward?
As for the next weeks, we see the lira is likely to the lira will recover more. However, and there we are again a bit more bearish than many others. The current scene resembles much more the situation of a breathing space rather than a new chapter of monetary stability. Markets still have a potentially politically motivated rate cut on the radar, and accordingly also possible withdrawal out of the lira. In sum, our base scenario is that the lira will end up in the CBRT's range, but this scenario has various substantial downside risks, notably in the form of external shocks. Basically, therefore, it remains to be seen how the government and the CBRT use this breathing space to improve Turkey's macroeconomy as a whole.
Fabian, thank you so much for your time and perspective today. Well, that's all from me for the moment, but make sure you click back for another exclusive interview with Ben Jones on today's German ZEW report. Bye for now.